Greetings, members one and all of the Salivation Nation. Well, what was predicted occurred, and the markets reacted. Let's take a look at what's going on with the interest rate hikes, with the Dow Jones Industrial Average, the economy, and gold and silver. Yes, looks like the Dow Jones Industrial Average took a hit after the Fed announced that they were going to raise rates a quarter point. And we're going to look into that a bit more. But before that announcement at 2 o'clock, we can see here that the market was pretty steady and stable with some expectations. We're going to explore why some of this had occurred and see where the market is and what has caused this drastic downturn. Another down day in the market is a little bit more of a cause of concern, considering how volatile the markets have been lately. But let's take a look here. The Dow, this is from CNBC, the Dow dives 250 points, closed at a new low for the year after the Fed rates hikes. The Dow, S&P 500, and NASDAQ all hit new lows for 2018 after the Fed hiked interest rates. The Dow gave up a 381-point gain and closed 351 points lower. The major indexes rolled over after Fed Chair Powell said the central banks would continue to shrink its balance sheet, tightening financial conditions. So the U.S. stocks sank Wednesday in a wild session after the Federal Reserve raised its benchmark overnight lending rate for the fourth time this year. The Dow Jones Industrial Average fell 351.98 points and closed at its lowest level so far this year at 23,326.66, erasing a 380-point gain that came prior to the Fed decision. The broad S&P 500 index also closed at a 2018 low, falling 1.5% to finish at 2506.96 as technology and bank stocks rolled over. The NASDAQ composite fell 2.1% to 6,636.83% in its own 2018 closing low, with shares of Apple losing more than 3%. The major indexes all hit intraday lows for the years as well. For traders, the Fed statement and Chairman Jerome Powell's subsequent press conference did not suggest that the central bank would slow its pace of rate hikes as quickly as some had hoped. Markets took a peg lower during Powell's comments that the central bank would continue to reduce the size of its balance sheet at the current pace. So that's a point that we should make clear. I was against this rate hike for today. I don't think they should have done it. I think that would have actually helped the economy and the markets overall, and maybe would have even brought the markets into a much more stable position. Maybe not necessarily raising the markets, but maybe keeping them level, as we see here on this chart here. They may have stayed relatively in that same area. There is we've heard the term everything bubble, and some of this could be just a naturalization of the market, coming back to reality, back from where it was. But nonetheless, the other thing is that people have to realize that this rate hike was baked in. Everybody expected it to happen. My hope that over the last few weeks and what we're seeing with the uncertainty with trade is that the Fed would maybe change their mind and not do a rate hike this time. But what the market is reacting to is not necessarily the rate hike, but they're reacting to the statement about next year. Essentially, they were predicting 3 rate hikes for next year, pulling back from originally planned 4 from prior statements because of some potential volatility or a fragile economy. Now they're only pulling back to 2. So they're only taking 1 rate hike off the table for now. And they're saying that things can change, but their forward guidance is pretty much telling them that everything remains the same now with the economy. Powell's comments talked about how really nothing's changed. The economy in and of itself is still good, and I believe that. I do believe the economy is good. It is fragile, but it is a strong economy. And I believe the low unemployment rate, increased wages, and all that stuff is real stuff. And I think that reality is what's being set in and being reflected when government gets out of the way And when government gets out of the way with less regulation and tax cuts, those are real dollars being created and circulated, not pumped up dollars by the Federal Reserve's quantitative easing program. Which, by the way, though we're in a period of quantitative tightening, doesn't mean that they have stopped printing money by any stretch of the imagination. And that will come back to bite us. I believe those 3 rounds of quantitative easings that have happened before will essentially come back to bite us in one form or another. And we still have some other things, which is why I think the economy is fragile. The article goes on to say about how the Dow and the S&P 500, which are both in corrections, are on track for the worst December for performance since the Great Depression in 1931. Now, that's a strange, that's a sentence that may scare some people, but the thing is that talking about the corrections, that just means that they're down 8 to 9% respectively this month, but it doesn't necessarily mean they can't recover from that. On track, they're on track for the worst December performance. The Dow has lost over 1,250 points this week. The Fed decided to hike its benchmark overnight lending rate by 1/4 point to Wednesday to a target range between 2.25% and 2.5%. The Fed did, however, trim its 2019 outlook for rate hikes to just 2, and I talked about that before. So there's a couple of indicators that could possibly trigger a recession. And Silver Bean Counter posted a great video talking about the bond yield curve between 2 and I think 10 years. If those are inverted, then there's a sign that there could be a possible recession. Another thing to look for is the GDP. If it gets below below 0, or where there's no growth at all, or goes into the negative range, then you're in recession for a certain amount of time. In other words, if it's I don't know, three quarters of no growth, no GDP growth, then we're in recession. So some of these recession numbers could be revised downward. There's a lot of signs that could lead to it. However, we'll see how that all plays out. I believe that the Fed probably should not have made any mention about what's going to happen in 2019, even though what they are saying is now, what they're predicting could change for a myriad of reasons. I don't think they're really taking into account some of these trade deals, unless they know something we don't with regards to the trade deals and where those are going to be, and the geopolitical environment for which we live. What about the quantitative easing? What about all that extra cash that's out there? Some of it has not been repatriated back here in the United States. I think the market reaction to all of this is the Fed going to overdo it, said James Paulson, chief market strategist at Lithold Group. Powell said he sees no problem with the balance sheet runoff. That's the one that hurts. There's another potential path for dovishness that he didn't take. The central bank permits $50 billion a month to run off the balance sheet, a collection of bonds and central banks bought to stimulate the economy during and after the financial crisis. I think that the runoff of the balance sheet has been smooth and has served its purpose, he said during a news conference. I don't see us changing that. And it goes on to talk about equities and the Treasury. Here's the Treasury. The benchmark 10-year Treasury note yield hit a fresh low of 2.798%. Its lowest since May 30th. The 30-year Treasury bond broke below 3%. The bond market seemed to believe the Fed has already slowed the economy by too much. So there you go. That's just it. And that's the thing that I don't agree with the Federal Reserve on, saying that the economy is getting too hot. It's not. And that's just it. If it was getting too hot, I could understand, or growing too fast, I could understand where that would be the case, where you'd want to raise hikes. But I do think that they ought to probably leave them alone, and probably shouldn't have raised them this time, especially considering all of that extra currency flying around. Let's see here. Complicating matters further for the central bank, President Donald Trump warned Tuesday that it must tread carefully in order not to make another mistake. And there's his his Twitter tweet there. I hope the people over at the Fed will read today's Wall Street Journal editorial before they make yet another mistake. Also, don't let the market become any more liquid than it already is. Stop with the 50 Bs. Feel the market. Don't just go by meaningless numbers. Yeah, we'll see. And the thing is the it's the Fed's got to be independent, but at the same time, there's question about if they really are. Are they working against this president, or are they, or what have you? That's been one of Trump's criticisms of the Fed when Janet Yellen was in charge. So we'll see how it all plays out. Nonetheless, one good thing that could come out of the Fed rate hike today is finally they're saying that it could lead to a slight increase in interest rates for those of us who have a little bit of money in the bank. And no, I don't have a whole lot there, but it's enough to kind of as a cushion just in case of an emergency. I believe it is important to have some money in savings. And it's getting way less than under 0.5%, much less. I'm very low. I don't even know what the number is, but it's pennies on the dollar interest per month. It's pitiful. So what does that mean if it goes up? If we get anywhere near 0.25%, I'd be surprised. And the interest rate, certainly not worth making any mention of, but they're saying that that's a good thing. But I think that might just be some media outlets trying to make positive of this. Nonetheless, what about gold and silver? What happened today with gold and silver because of these rate hikes? Well, the only metal that really reacted positively is palladium. Yes, and as expected, and as is usually the case, when the Feds raise the interest rates, it does tend to bolster the dollar, which has an effect on precious metals, and we can see that today. That gold has been knocked back down to its levels that we saw prior these last couple of days where they've gone up. So gold is to $1243.97 here. And silver is at $14.62 or 63 cents there, and a ticker above, which is updated more frequently. And platinum is down $7, $7.89. Well, actually $5 there, so these are a little different here. So it's palladium is up though, up $17, well above gold. Palladium is now the king of the precious metals, at least on this chart here. Outside of rhodium, which is not shown here, because rhodium is so rare, it really is tracked very minimally. Its usage, but it's over $2,000. I'm sure it still is, but so it's very interesting. It's very it's going to be an interesting a couple of weeks and months here to see where things play out for 2019. We also have the fear of a government shutdown, which is playing in the markets as well. Although in reality, when the government shuts down, only about 17% of the government doesn't function, and that's in discretionary things. Nobody's Social Security checks will be stopped. Everybody's going to get Medicaid, Medicare, all of the things that people rely on. The entitlements will still continue to happen. It's the unessentials parts of government will be shut down if it were to occur. It doesn't sound like that's going to happen. All paths are saying that Trump may capitulate on this, and there may not be a government shutdown. But nonetheless, I think the market's a little bit nervous, and probably will be nervous until Friday or Saturday, whenever they come to the deadline to fund the government. We'll see how it all plays out. Nonetheless. And everything has a reaction, and there's a lot of different things and parts to play in an economic situation that we're seeing. It's a delicate market. There's no ifs, ands, or buts about it. But there's also a lot that goes on behind the scenes that we're not aware of, and a lot of it is automated. As you know, there's a lot of automation. There's a lot of algorithms and things at play, which is why we see some of these little quick spikes and dips in the markets and with precious metals or anything else that is tracked with the price, ETFs and the like. But nonetheless, when we hold the physical, we know it can't be manipulated. We know there's no algorithms in it. We know we count our ounces, we hold it, we cherish it. We understand that as a long-term hold, it's going to protect us in times of economic strife. And that's why we're here. So all we have to do is hold fast and hang on. We don't wish for a bad economy. We want things to recover. I've always said, even though I strongly disagree with the prior administration, I'd rather see America do great. I'd rather see the American economy and ingenuity prosper in spite of policies that are essentially socialism, which is what Barack Obama was offering. I'd rather see that in the face of a burdensome federal government. I'd rather see us do well, even if it doesn't, bode well politically for my ideological point of view. So, and that's the case now. I want the economy to do well. I'd rather the economy do well and precious metal prices stay low, so we can continue to accumulate these metals and to serve their purpose, and that is as an insurance policy for when things do go bad. But as you know, and as I've always said, recessions and economic downturns are natural occurrences. They just happen. That's a part of life. If you look at a chart over the past 100 years or so, there's been a recession about once on average every 9 years. And so things happen. It's just that a lot of the decisions that have been made by Republicans and Democrats over the last 30 years have really, really hurt things in the long term by kicking the can down the road. And so I think that's why, even though I'm not a doom and gloomer, it's not hard to understand why some people may feel that, the next thing that does hit is going to bite us much harder than prior times. But I do believe in free market principles, and the more you can get the government out of the way and get people and business operating and running, then I think that when this next downturn hits, the flexibility and the ingenuity that is the American spirit, and small business, large business, that it will recover. It's elastic. People are amazing and how quickly they can adapt to situations. Had we not bailed out the auto companies in 2007, 2008, or even the big banks, we would have been just fine, because somebody would have done something to find a way that would work naturally and be effective. And that's about efficiency. And that's what the American spirit is about: efficiency and entrepreneurship and ingenuity. Microsoft started in a basement. Steve Jobs and Apple started very humble beginnings, these companies, and look at what they've built. It's amazing. It's fascinating. And that's how it works. That's the American spirit. So with that being said, post your thoughts below. I'd like to extend a multitude of gratitude, y'all, for watching, and encourage you to please rate, comment, and subscribe.